Ready? So two things we want to do today. Finish up on the financial system, a couple of issues that we still need to talk about, and then a little bit of a discussion on the party that we're going to have next Tuesday. Okay, so one of the things to keep in mind about the financial system, we saw from our schematic last time that we have both direct finance and indirect finance. One thing I did not mention is that, in general, direct finance is more expensive than direct finance. If you remember, indirect finance has all those financial intermediaries. These are these big behemoth organizations in general, insurance companies, pension funds, commercial banks. Right? They have lots of expenses associated with just maintaining that kind of institutional structure. So consequently, in general, borrowing from a financial intermediary will be more expensive than doing the same borrowing through the financial markets directly, assuming, of course, that you can actually access the financial markets directly. Now, that may very well be true for the government, and it may be very well be true for large corporations. It's generally not true for individuals, nor would it be true for most small businesses. So most individuals and small businesses, then, access the financial markets through a financial intermediary, despite the higher costs. Now, with that, there are also some informational issues that can cause some difficulties for financial intermediaries. So last time we looked at things like bank runs and liquidity crises and solvency crises, but these are some other issues that arise inside the financial system, and particularly with financial intermediaries. So the first of these is what is known as asymmetric information. With asymmetric information, what we're saying is that in any given transaction or exchange, one party to the transaction has more relevant information about the transaction than the other party. Right? So you have two different groups of people, or institutions and an individual, two individuals, whatever it might be, they're going to make some sort of an exchange. And somebody over here knows more about what's relevant to that transaction than the person over here. So that's what we mean. So asymmetric information, then, can actually be subdivided into two other components, something known as adverse selection and moral hazard. Okay? So with adverse selection, we're talking about the amount of information that is available to the parties before the transaction is actually undertaken. Okay? Before the transaction is actually undertaken. So let me give you an example. Let's suppose that, let's say we're in phase 1 for spring, right? So you need to register. Now, let's suppose that you're registering for the classes that you want to take in spring, but the only information that you have is the course name and number, right? Econ 100B, macroeconomic analysis. Suppose that's all that you know. You don't know how big the class is. You don't know what the assignments are. You don't know anybody that's taken that class. You don't know who the professor is. You know nothing else, right? But you've got to pick just on the basis of that information. Ooh, what's the probability that you can make a bad choice? See? Now, on the other side, the professor who's going to be teaching that class knows a lot of things. He doesn't know who you are yet, but the professor is going to know how the course is going to be structured. What's the book? What the registration maximum is going to be. How hard or easy the professor is going to be in the class. Right? All of those things, the professor who's offering the class will know, but you won't. So in this case, you make a selection, Econ 100B. And then you get into the class and you go, golly, that professor is terrible. Those exams, especially those multiple choice questions, they make me want to pull my hair out. This is really bad. Notice, you've made a selection, but by not having the right information, the selection that you made turned out to have adverse consequences for you. Let me give you another example. It has nothing to do with professors. Let's think about an insurance company. It doesn't matter whether we think about health insurance, life insurance, auto insurance. From an insurance company's perspective, they would like to find the healthiest people for health insurance, people who are going to live a really long time for life insurance, and people who are really safe drivers for auto insurance. Right? That's what the insurance companies, those are the clients that they really want. But what they see is a lot of applications for insurance. So anybody can put in an application for health insurance, life insurance, auto insurance. In that transaction, who's likely to have better information about your health, your longevity, whether or not you're a safe driver? You as the individual, or the insurance company simply looking at your application? Well, it's obviously you. Right? You know whether you're a safe driver or not, regardless of what you tell yourself as whether or not you're a safe driver. You know whether you're a safe driver or not. Right? You know if you're generally healthy. You know, generally, based on your family history and a bunch of other things, whether you're likely to die at a relatively young age or perhaps a relatively old age. So that's all information that you have that the insurance company doesn't have. So now the insurance company runs the risk of selecting unhealthy customers who are bad drivers and aren't going to live very long. So in this case, if they make that kind of selection, it'll have adverse financial consequences for the insurance company. They'll have to pay out health insurance claims, life insurance claims, auto collision claims sooner rather than later. Right? The selection process has been adverse for the insurance company. Now, we'll talk about ways of trying to minimize adverse selection in just a few minutes. But that hopefully will give you an idea of what we mean by adverse selection. The second problem that happens with asymmetric information is something known as moral hazard. Moral hazard is a change in behavior after the transaction takes place. So in this case, let's suppose that you are applying for auto insurance, and you tell them, the insurance company, they always ask, well, what kind of car do you drive? And you write down, I drive a super safe Volvo station wagon. And one of the things that the insurance company knows is that, first, Volvo station wagons are quite safe, and second, drivers of Volvo station wagons are amongst the most cautious drivers in the country. Which, by the way, may be one of the reasons that Volvo station wagons are so safe. They're driven by really cautious drivers. And they say, oh, wow, we'll give you a really good policy at a discounted rate because you're obviously a good driver because you drive a Volvo station wagon. And once you get the policy, you say, this thing really reminds me of a mommy car. I'm going to junk this thing, and I'm going to get, let's see, how about a 400 horsepower red Ford Mustang convertible, right? I'll bet at 2 a.m. when there are very few other cars on the freeway, I'll bet I can get this thing up over 100 miles an hour. So let's go try, right? Notice, once you got your insurance policy, you changed your behavior, the way that you would drive. This is a problem with what we call moral hazard. After the transaction has taken place, you change the way you behave. Let me give you a business example because this actually happened to me a number of years ago. I was working with a startup company as a consultant, not as an employee, although they gave me a tiny slice of options. So what the startup company, I was literally in on the ground floor with the company. We had very limited funding in the beginning. After all, we didn't have a product yet. We didn't have any customers yet. But we quickly developed some products. We quickly acquired some clients. And all of a sudden, some angel investors decided that they wanted to put $10 million into our company. Now, it turns out that we have been really operating on a shoestring. I mean, the owners were basically funding the operation with their life savings, and most of the people, including the consultants at that point, were working for options and not for paychecks. Something, by the way, I don't recommend. Okay, so we get this big slug of money, and I can remember hearing one of the co-founders say, wow, $10 million. We'll never be able to spend all of that. And so, what happened? A, we started to have lunch brought in every day. B, every Friday afternoon, we had an office outing someplace. Notice, before the transaction took place, we behaved one way. After the money was in, our behavior changed. Right? There was no way for the angel investors to know exactly how our behavior would change. But it did. Moral hazard. Right? You give somebody something, they change their behavior because of that. Come back to moral hazard a little bit later. Okay, the second big problem with asymmetric information is something that is known as the free rider problem. This is what I actually prefer to call the Warren Buffett problem. So Warren Buffett, of course, runs Berkshire Hathaway, his investment company that he works, runs. And every quarter, Berkshire Hathaway has to report to the Securities and Exchange Commission its income statement and balance sheet. And on its balance sheet, it shows everything that they own. And so, realizing that Warren Buffett is a really smart and successful investor, you might say, well, let me look at this quarter's balance sheet, compare it to the prior quarter's balance sheet, let me figure out what they were buying and selling. And then I'll buy what he buys, and I'll sell what he sells. Because after all, he's been really, really, really successful. The guy's got a ton of money. I mean, literally, a ton of money. $50 billion will do that for you. It weighs something. So, what's happened? Well, we know that Warren Buffett's analysts do the work, right? They do a lot of work to figure out what the right investments are, what to buy, what to sell, what to get rid of. But I'm just following what he does. I haven't devoted any resources to doing that. Maybe I should be devoting some resources to doing that, right? Why should I take his word for it? He makes mistakes after all. So by not doing my own work, we're under-investing in research. Basically, I am free riding on the research that Berkshire Hathaway has done. Now, this might not sound like it's a particularly big deal. So let me give you another example where it turned out to be a really, really big deal. In 2005, 6, and 7, we were building and selling lots of houses. People were taking out mortgages. People were refinancing their houses with new mortgages. And the investment banks would buy up all these mortgages and they'd put them in a package, squish them all together. And then they'd carve out little pieces of the cash flow. And they would sell those off. And each one of those pieces had a different risk-reward component to it. So obviously the ones that had the lowest risk, lowest return, lowest risk also had the lowest return, and the ones that had the highest risk had the highest return. And they would sell these pieces of these mortgage-backed securities out. Now it turns out that these kinds of securities are actually quite complex to analyze. So investors generally did not want to analyze them. It took real resources in terms of people and computing power and information and education to know exactly how to analyze a mortgage-backed security, something that most people don't have. So what did they do? They didn't want to buy them blind. So they looked to the credit rating agencies to do the research for them. So what they found was, well, gee, how does Moody's or Standard & Poor's or Fitch, how do they rate that piece of that mortgage-backed security? Oh, if they say it's AAA, it must be AAA. I don't have to do anything to look at that. They're reputable firms. And if they say it's a BAA, well, I know that's not as good as a AAA, but it has a higher rate of interest on it, and it still has a pretty low probability of default. And so lots of people bought those kinds of things, and down through the risk matrix. Problem, by not doing your own research, the credit rating agencies were wrong. I don't mean wrong by a little bit. I mean they were really wrong. A AAA security is supposed to have a 99.5% payoff rate, right? 0.5% defaults. There were AAA-rated mortgage-backed securities that had 95% default rates. That's not missing by a little. That's missing by a mile, right? And one of the reasons the financial crisis was so bad, investors were basically free riding on credit rating agencies' research, which turned out not to be all that good. Okay? So free riding can be an issue too. When you make information publicly available, too few resources will be devoted to doing independent research. Now, one of the things that financial intermediaries do to try to address these problems is to issue what we refer to as private, non-traded loans. Right? So in this case, what we're talking about is the financial institution is going to make you a loan. It's going to hold the loan on its own books so that it's accepting all of the risk of having made that loan. To avoid an adverse selection problem, in order to make that loan, it's going to require you to show it a lot of information. So if you're running a small business and you want to borrow money to have more inventory, to expand your factory, to buy some additional machines, whatever, and you go to the bank or a financial intermediary to borrow money, they're going to say, fine. By the way, I want you to fill out all this paperwork. I need to see your company's income statement and balance sheet for the last X number of years. If you're a really small company and you're the owner, they might say, and I want to see your personal income tax returns for the last 3-5 years, whatever it is. Right? They want to collect a lot of information on you in order to know that you're a good risk. Okay? So that helps the bank or the financial intermediary to minimize the adverse selection problem. The other thing, though, that it does is that by not trading that loan away, they keep all of that information private. That helps to lock in the customer. Right? There's a whole series of things that has to go on with that information flow, but the financial intermediary holds on to that information so that no other financial institution can free ride on it. Notice that if Bank of America had given you the loan and then all of your information was made publicly available, another financial institution, let's just call it Wells Fargo, could come in and offer you a lower interest rate. But it didn't have to go through all the paperwork and evaluations of collecting the information. So private loans have a tendency to reduce free riding problems. As I said, collecting all that information is also going to have the effect of minimizing adverse selection. In order to try to reduce adverse selection even further, financial intermediaries also look at your credit report. Right? What's your FICO score? What does your credit report show? So what this tells them is how regular are you paying on your outstanding debt. Right? If you've had debt for a number of years and you've made regular payments on time, then it looks like you're probably pretty good at meeting your obligations. But if you're missing payments, if you've defaulted on a loan, that's all going to show up. Guess what the number one predictor of an individual, a company, or a country defaulting on its debt? The number one predictor, that they've defaulted before. Why anyone was surprised that Greece defaulted a couple of years ago on their sovereign debt really surprises me. Because Greece has been in default on their sovereign debt about 2/3 of the time over the last 150 years. Why was anybody surprised when Argentina defaulted on their sovereign debt back in the early 2000s? They did it before, in the 1990s. Oh, and the 1980s. Oh, yeah, and in the 1970s. Right? You do it once, you get really good at it after a while, right? You do it once, there's a good chance you're going to do it again. So your credit report, credit standards, tell you something about what your probability of default is. So again, a way of reducing adverse selection. Third, moral hazard. We don't want people to change their behavior after the transaction. So one of the ways to do that in financial transactions is to impose what are known as loan covenants. These are the rules that are part of the loan that require the borrower to do certain types of things or to prevent them from doing certain other types of things. So you can think of a lot of different kinds of loan covenants that might be in there. One of which might say something like the following. I'll lend you $1 million. However, you must keep $100,000 of that, 10%, in your checking account at our bank for which you cannot touch that money. So in essence, I'm lending you $1 million, but you're only really getting $900,000. But you're paying interest on the entire $1 million. And by the way, while the money is sitting in your checking account earning $0, I can lend that money out again as a financial institution and make some more money on it. Right? So it's a way of making the borrower have some risk in defaulting on the loan. That's what we're looking for. Probably the most common loan covenant that's put into loans are what are known as collateral requirements. Collateral. So in this case, in order to borrow money, you have to pledge something, generally something physical of value, to back up that loan. So in the United States, I think it's all, mortgage loans are collateralized. When you borrow money to buy a house, guess what? You put the house and the land up as collateral. You default, the house and the land go to the bank or the lender. Right? You're out. So if you're ever thinking about defaulting on your house, make sure you don't have positive equity in it. That means it's worth more than you owe. Okay? So collateral requirements are often there, not just for individual borrowers, right, but also for corporate or business borrowers. It's not uncommon in a business loan that the collateral might be the building that they own, or the inventories, or if it's a railroad, the rolling stock. If it's an electric utility, it might be a generating facility. But something physical and something of value. In some cases, depending upon how risky the borrower is perceived, the collateral might actually exceed the value of the loan. That's not typical, but it does happen. You're really, really risky. They want more collateral than they're willing to lend you. Now remember, most collateral is illiquid. You're trying to get liquid funds. So you may very well be willing to put up your $1 million house against a $500,000 loan, and that happens. I've also seen a case where a small business in particular wants to borrow money from a bank, and they have to pledge the company's physical assets, and sometimes the owner's personal property, car, boat, house, all of those things as well. Generally not their firstborn child, though. So collateral then has the effect of reducing the consequences of adverse selection. Right? If I made a bad choice and you do default, at least I've got the collateral that I can seize. And it also has a tendency to reduce, but not eliminate, moral hazard. When the borrowers have more skin in the game, they have less incentive or reason to change their behavior after borrowing the money. Now, this is what financial institutions look at. But what we have to also remember is, and what we saw on Tuesday, the profits of a financial institution depend upon the net interest margin. That is the earnings on its assets minus its cost of its funding. Right? So that difference. And one way to raise the return on equity is to have more assets, to have higher leverage. But we also saw on Tuesday that having more leverage comes with some real risks. If the value of the assets decline, the greater the leverage, the greater the probability the institution will become insolvent. Right? The reward, of course, is more assets, more profits, greater compensation for the executives. So we've got this kind of tug-of-war going on between incentives and costs. We also have to remember, too, that when banks fail or get into severe difficulty, there are consequences for the overall economy. We've seen this in particular in the last 6 years. So one of the things that comes out of that is government regulation and supervision. Right? How do we try to minimize the asymmetric information between financial institutions and investors, and between financial institutions and depositors? So government can come in here and do two things. The first thing that it does do is that it